I'm particularly excited to be back here since I participated a couple of years ago in 2016, and listening to the tremendous progress that so many of you have made has been very, very inspiring to me. At the same time, we heard that it's very difficult to make the connection, particularly from institutional capital to the sisters on the ground and everybody working on the ground to help alleviate poverty on that level. And that is the topic of this panel. I'm joined by a world-class team of panelists here. Jean-Michel Severino. He is the CEO of Investisseurs et Partenaires. Welcome. Deborah Schwartz, Managing Director of Impact Investing at MacArthur Foundation. And to her right, Rufus Whitley, President and CIO of Oblates Investment Trust. I will ask the panelists to introduce themselves a little bit more so that I can continue with my introductory remarks. And so what we decided to do is go 2 rounds of fairly quick-paced comments. And the first one will set the stage of what each one of us does in the context of deep impact, in the context of solving some problems with going and serving the bottom of the pyramid. And then the second round of comments will be that we tap into our collective wisdom to figure out what the field needs and why it is that institutional capital has not yet scaled to make a difference on the bottom of the pyramid and what we can do about that. And then we open it up for a Q&A. So my own background is actually high tech, and I worked in Silicon Valley for a number of years, and that created quite a bit of wealth for me and my family. And so my wife Lisa and I had to figure out what to do with this wealth, and we decided to do what now is called impact investing. And so we have been at it for over 15 years, and have tried to go as deep as possible with the constraints that normal investors would have. And so since this is the third time for many of you to participate in talking about impact, I will dig a little deeper into some of the trade-offs and some of the issues that you will run into as you actually go deeper and as it pertains to the bottom of the pyramid and institutional capital particularly. So after this liquidity event, which is called liquidity events in Silicon Valley, we had to figure out what the meaning of wealth is, and to us, the only possible answer, which it is to many of you as well, is that the only meaning of wealth is to actually make a positive contribution to humanity and the planet. It cannot possibly just be there to serve itself, right? And so once you do that, then you say, well, but the current system, as Sir Ronnie pointed out in his introductory remarks, doesn't really deal with that. It's part of the problem, particularly the financial system. And so Lisa and I decided that we would want to dedicate the rest of our lives to help change the financial system such that Sir Ronnie's vision of integrating impact tightly into modern portfolio theory to understand the relationship between impact and risk and return will become a reality in the not too distant future. So you might ask yourself, how do you change the financial system if you're just a small investor like us, right? Well, so we identified a couple of leverage points. And they are to go all in, to say we are creating a 100% impact portfolio across all asset classes, and we're going to create a movement across the globe to inspire hundreds of others to do the same. So it's not only about early stage deals, it's not only about direct debt and direct equity, it is actually to create a whole portfolio, including maybe public equities, in investing in impact. So to give you an example of what we invest in order to change the system, so we do invest in first-time funds. So institutional capital, as you heard, cannot invest because of various restrictions, perceived or not perceived, into first-time funds. But the first-time funds, if they don't get the capital to try out their theory of change, they will never go to scale, and therefore it's a catch-22 that institutional investors cannot really invest in that. So we invested in Better Ventures, Aquaspark, a great fund out of the Netherlands with an open-ended structure that we like, and our capital, contributed to their first close of about 10 million. Now they're at 70 million, and going into the asset under management where institutional capital could actually come in. We invest in first financial instruments, like we invested in the first social impact bond that Sir Ronnie mentioned about, 8 years ago, and we did get 3% return. And because we wanted to help ignite a new wave of instruments that now is not really getting to scale yet, but hopefully it will over time. We are supporting the wave of democratization efforts to allow non-rich people to participate in impact by investing in new structures like social stock exchange and others. We think that the model of venture capital is not the right model for impact, because venture capital is maximizing for a single time exit to maximize the returns of the LPs and has no discernible concern about sustainable impact, and we're just the opposite. We want sustainable impact with an appropriate financial return, right? And so we need to, we invest in new term sheets and infrastructures that enable us to prepare to have more examples like this, more data points for this, so that bigger capital can come in and copy what we do. So 2 more points, and then I hand over to the panelists. Blended capital. So we talked about A1, A2, B1, 2. There was no B3, right? But C1, 2, and 3. We do all of that, right? Because you need to, yeah? One is not better than the other. It's not about being better or being even more impactful. We need to deploy the whole continuum in order to maximize the impact. We use our grants only in conjunction with other capital in order to have a bigger impact than grants only or investment only can do. So if you're in the audience and you have grants and B1 and B2 capital and C1 and C2 grants, then you should deploy in combined ways, right? And so we actually create our own deal flow by supporting accelerators for social entrepreneurs. I started one of the first ones in India, and Vinay, my friend here, was part of that effort, and now it's beautifully scaling with Dasra, our Indian partner company, to go to scale, right? And it not only supports for-profit social enterprises, but also not-for-profit social enterprises that deserve to be supported, right? And then Lisa, my wife, she's doing one in Honolulu. She's part Hawaiian, for Hawaiian entrepreneurs to help create the island economies of sustainability that they deserve, with the aloha spirit and spirituality that goes along with that. And then we created a global network of impact investors called Tonic. And it's no accident that it's called Tonic. Where's Amit? Okay, so he's not here, but he would agree with me that we started Tonic a year after he started GIN in order to complement the global network of impact investors for institutional capital, for people like us, for people with private capital that are innovative and can explore deeper than they can the impact that we want to have. And we have about 200 memberships around the globe on that, and about half of them are 100%ers like myself. And there's others in the room here too, where we dedicate 100% of our investable assets to impact. Now, we don't do this as an intellectual exercise of making money or proving impact. We do this because of who we are, because of really who we are, more than our brains, more than the PhD. I have a PhD in computer science, and it totally wants to select everything and segment everything, and I calm it down once in a while. But we do it in order to express the change that we want to have, right? So our portfolio is expressing the change in the financial system that we want to have, and the challenge for this panel is to figure out how we can build portfolios, including institutional capital, that can actually make a meaningful impact on the bottom of the pyramid. So with this, I would like to start the first round of comments with Jean-Michel and ask him and then the other panelists to explain what their organization is doing, particularly in the context of going deep and the bottom of the pyramid. Jean-Michel. I time you out.
Good morning, everybody.
Okay.
Here we go.
Yes. Good morning, everybody. I'm very happy to be here. I'm very proud to be here and honored with my 2 panelists to talk about this major challenge of going deeper in the impact industry and addressing the challenge of the bottom of the pyramid. This is what our firm has been doing now for the past 15 years. We were created as an impact investment firm by a gentleman who had spent most of his career in the private equity industry and was willing to turn his knowledge and his wisdom into fighting against poverty. And we have been doing that for the past 15 years, I said, through 2 sets of programs. One is called IPDEF2, INP for development. And it's a program that is there to create investment firms in poor and fragile countries. You prefer that one? Okay, thank you. So this program is there to create local investment firms in poor and fragile countries in Africa. And another program which is called INP Africa Entrepreneurs, which is focused around the promotion and the emergence of African entrepreneurs, which is an SME and startup program that we run across Africa. Overall, in those 15 years, we have gathered and invested around 170 million euros, close to $200 million. We have invested in around 80 firms. And this thanks to around 70 investors. Some are here in this room, by the way, and I thank them and I congratulate them for having been audacious enough, especially when we were just starting all this venture, to come and help us. What I would like to say and to share at the beginning is that, because you asked us to make it clear through examples what we were doing, is that we are not only focusing on bottom of the pyramid, because promoting entrepreneurs and African entrepreneurs is something that can lead us into areas of activities that are not especially related to poverty alleviation per se. But I would say that 75% of what we do is that, because we operate in very poor and fragile countries, in Madagascar, in Mali, in Sahel in general, in Mauritania. We are also there in conflict-ridden countries. And we try to address this bottom of the pyramid challenge in two ways. One is to support businesses which provide services and access to services and goods to very poor people. And one good example of what we did, among many other corporations, is the business that we helped creating in Mauritania. It's a firm called Comptoir du Solaire, CDS, which started from nothing and which provides water and energy, access to water and energy in the valley of the river Senegal. For those who know the place, it's an extremely poor part of the world and even one of the poorest parts of Africa. It's also a part of Africa which is particularly hit by drought and climate change, and it's also a major place for migration in Africa and towards Europe as well. So it's a hot spot when we talk about right now the migrant flows which are crossing the Mediterranean. So we helped creating this business. It grew as a very successful activity, a very profitable one also over the years, and we ended by exiting from this investment and selling it to a large multinational corporation, Engie, and another impact fund from Monaco. The two joined to help this business crossing other areas. And in this particular instance, the key point was to create methodologies that would allow the provision of water for energy to be very cheap, so that very poor people could have access to it. Another example, and I will stop with that, is what we do this type not in providing goods and services to poor people, but helping creating jobs and economic opportunities for poor people, which is the other way you can really address the challenge of poverty alleviation in very poor and fragile countries. And an example of that is a business that we also helped creating in Burkina Faso. It's a startup called Seattle, and this business is buying soy from dozens of thousands of households in the south part of Burkina Faso, close to the border of Ghana. And it transformed the soy into oil for human consumption and for also the animal breeding, cattle breeding value chain. And in this case, it has helped tens of thousands of farmers to increase their revenues and have access to economic opportunities and social opportunities they would never have dreamt of. So this is type of, we are still investing. We have not divested from this business as well.
Maybe, Jean-Michel, explain who are your investors, just so that we know who is demanding what type of impact and maybe financial return.
Okay, we have slightly different investors depending on the type of vehicles we operate. In our IPDev program, which is about creating all those investment firms and financial corporations in countries like Senegal, Madagascar, Mali, Niger, etc. We do that through a holding corporation, which financial goal is to break even plus. So we would like to return 2-3%, but we
In euros.
In euros, and we benefit from a risk coverage guarantee from the French Development Agency. So in this vehicle, as a consequence, most of our investors are either public institutions dedicated to development or private investors, foundations, which have a deep dedication to poverty alleviation because they know their returns will be relatively low, even if they are safe in nominal terms. And that's why, by the way, we have some of those investors here in the room. In the case of our SME fund, it's a broader crowd because we can reach higher returns. We can hope to return from 8 to 10% in net terms to our investors. And then we have a very large variety of investors, public institutions, but also large institutions like AXA, Société Générale, who have interest in development in Africa. We have high net worth individuals. We have all sorts of foundations, but we have also more return orientations. So it's a broader set of investors.
Thank you so much. Let's move over to Deborah.
Good morning. Thank you, Charlie. It's a great pleasure to be here, and I thank CRS and all the others that have been involved in making this conference come about. And the MacArthur Foundation is proud to be here to share some of our experience with you. MacArthur is a global philanthropy. We're headquartered in Chicago, Illinois, but we have offices in India, Nigeria, and Mexico. And we make grants totaling about $250 million a year to organizations at work around the world. We focus on a small number of what we call big bets in our grant making. That includes work on climate change, work on criminal justice reform, reducing the risk of nuclear war and other issues. And we have an enduring commitment to promoting independent media and journalism. And we're well known for something called the MacArthur Fellows, often known in the press as the Genius Grants, where we give awards once a year to a group of exceptionally creative people. And most recently, I think we became known for 100 and Change, which was a competition that just completed where we gave $100 million to a single group working on a single big problem, showing that solutions are possible. And that organization was Sesame Street Workshop in partnership with an organization dedicated to working on refugee issues. I share that background because the impact investing we do links to our grant making. We are fundamentally at our core a philanthropy, and we've been doing impact investing for 35 years. We've provided loans and guarantees and investments to over 200 organizations, the vast majority in the United States, but not all by any stretch. And over the years, those investments, those impact investments have touched on women's health, education, housing has been a big focus, community development, and many of them have been targeted to our topic today, which is the very, very poor, folks who really are not providing a commercial investment opportunity, as Matt talked about toward the end of his panel. Not every organization has an economic profile, has a customer base, has a model that is going to yield this perfect win-win. And I would say that the nature of our impact investing is to recognize that we have extraordinary flexibility, and we can be patient, we can be risk tolerant, we can take more modest returns where we need to, we can, as Charlie alluded to, operate in sort of unfamiliar ways and do creative things with the terms that we offer in order to be a problem solver, in order to be a catalyst. And I really commend the conference organizers and Matt and everyone on their panel for leading us off in a session on impact investing, talking about the continuum, talking about the fact that not everything is going to look the same from an investment perspective. And what I would emphasize is that in MacArthur's experience, it's not either or. It's not an all or nothing proposition where you can either be commercial or you have to be deeply concessionary or grant. What we have found, and where we've seen the most exciting results in many cases, is being able to blend, being able to sequence, being the early money that comes in and takes the risk on an unproven enterprise and scales that up to the place where the next level of capital can come in, or in many cases being the anchor as part of a blended structure, creating funds or creating situations where our money can come in with one set of characteristics and institutional money can come in either alongside or subsequently. I'll give just two quick examples of the work that we've done that illustrates sort of how we get to the base of the pyramid. And then look forward to talking more about the role of catalytic capital as we get to the second part of the session. One example I want to give you comes from something recent. We created in 2016, for the first time ever, a fund managed by MacArthur. So we're an asset owner, but we wanted to create a vehicle for other investors to easily join with us in our deep impact investing, in our catalytic work. And so we created something called Benefit Chicago in collaboration with Calvert Foundation, who's also here and a wonderful partner, and a community foundation in Chicago. And we are using Benefit Chicago, which is a $100 million vehicle, to make very high risk, very unusual investments that fill capital gaps, that go in where other lenders will not. And one example is a small business called Sweet Beginnings. And the whole focus of this business is providing job experience to men, for the most part, who are coming out of prison, who may have no formal job experience at all, are not employable as it stands, and really need to prove themselves to be able to move on in their lives. And Sweet Beginnings has hit upon the idea of raising bees, honeybees, as a way to create that employment, hence the name. And so these men go about becoming beekeepers on the west side of Chicago in one of the most impoverished neighborhoods in the city. Almost half of the people live below the poverty line in that community. And then they make products make honey, and they make other kinds of honey-based products, and those are being sold in Whole Foods and other kinds of stores. This is not a business that is going to, break any big records on the profit-making standpoint. It's a pretty high-touch business to be providing employment to this population, but they don't need grants. They really needed capital, and our working capital loan to them of $500,000 helped them raise sales by 146% within the first 6 months. So that's just one example. And the other that I'll give really quickly, I thought of because of comments at the end of the last session. We did a 15-year initiative, almost $200 million, focused on nothing but the issue of affordable rental housing. And what we did was we provided loans that were very patient, 10 years, low cost, 1 or 2%, unsecured, to nonprofit organizations that were fully dedicated to affordable housing, and doing it in a way that is really service enriched and providing support for the formerly homeless, to the very poor elderly, to families living on welfare and within just populations that the regular marketplace did not want to serve. Well, one of those organizations ended up doing a project in Annapolis, Maryland, working with a convent. And that convent had a very small community of sisters who were still living there, and yet it was not economic for them to keep the property maintained. And what ended up happening was that the property was sold to the nonprofit, which we had financed, and they had used some of our money to help them put the financing package together. And those sisters are now continuing to live through their retirement in a beautifully maintained property. And what they did with the excess space in the convent was to create apartments for grandparents who were taking care of their grandchildren as foster parents, because their own children had fallen into drug abuse or into criminal activity and could no longer care for their kids. And one of the most beautiful things that we saw when we toured the property was how the sisters had the opportunity to interact with the young children that were now living on the property. So,
Beautiful example. Thank you, Deborah. Let's move over to Rufus.
Rufus Whitley, I serve as the CIO of the Oblate International Pastoral Investment Trust. And when you look at that continuum that we were presented in the beginning, the trust is certainly tilted toward A1 and A2 with a slight commitment to the B section. And that's for a very simple reason. We manage the money of over 100 participants, 250 sub-accounts, primarily, well, they have to be Roman Catholic related institutions because of our relationship with the SEC. But more importantly, it grows out of the charism of the Oblate Order, which is to reach out and minister to the most abandoned. So the large portion of our money comes from Roman Catholic institutions located in the developing world. And the money we receive is their patrimonial money to support health care of their ministers and their operations and ministries, hospitals, schools, or whatever. So you have to think of it as endowment money, and we work with them to take a prudent withdrawal. The other characteristic of the participant base is that the accounts tend to be relatively small, which was one of the original insights. They were unable to obtain professional investment management services in their home countries because of the size of money. $500,000, you're not going to have a widely diversified portfolio, and you're not going to have a lot of investment managers knocking on your door. So by amalgamating it, we've been able to provide a diversified program of investment across the public and private markets, all of it guided by a faith-consistent investment. So the negative screening is in all portions. In terms of the impact portion, it's primarily located in the private market segment of our investments, which constitute a little over 30 to 35% of the total portfolio. Within that, we do both concessional impact investing and what we would call market rate investments. The concessional investments that we make are targeted primarily to new and emerging products or managers in high-risk areas. So they're basically non-US, non-European areas. And we consciously choose to do the catalytic tranches of those particular investments. Our rationale is very simple. If we're reaching out to the most abandoned as a charism, and where money that we receive come from developing parts of the world and conflicted parts of the world, the questions our participants ask us many times are, is our money basically being drained from the country we're dedicated to, or is in some way it's being used to develop that country? So one of the ways in which we try to respond to that need is to be able to say, through the catalytic support of investment firms, micro-lending firms, in conflictive zones, in developing areas, we're hoping that our catalytic base, which is first risk money, allows those funds to grow and nourish. So that's one portion of our focus. The other portion of our focus is, as I said, market rate impact returns. I can't give you a lot of stories in the sense that we invested in this project or that project or this project, because we're frankly precluded from making direct investments, again, by the nature of the regulatory framework we live in. So we have to mediate all of our investments through registered investment advisors. So we're essentially relating with firms that do impact investing. Our primary focus is, again, outside the United States. And we have a specific preference right now for the country of Africa. That really shows you how myopic I am. The continent of Africa, and with a further sub-focus on sub-Saharan Africa all the way up to the Democratic Republic of the Congo. I guess the other issue that is important for us, and I think is one of the issues that we struggle with, it's what I call quasi-impact investment. And by that I mean we invest with a fair number of firms that we serve on the advisory board of, or that we know fairly well, that would not characterize themselves as impact investors. They've been around a long time, and a generic example would be some of the biofarm venture firms that we invest in. Some of them are doing tremendous work in terms of development of medicines for a variety of illnesses, some of them neglected. They wouldn't characterize their work as impact, yet I believe there's a strong impact component in it. They wouldn't qualify as an impact firm because they've got some other investments, and I'll say women's cosmetics and be in trouble for using that as an example, which may not be considered an impact investment. One of the things that we've tried to do is to challenge those firms to begin to bring the impact matrix into their investment decisions, and almost to say to them, can it be one of the additional criteria you look at beyond what's the expected rate of return, what's the length of time, what's your exit strategy, but what is the actual output or outcome of what you're doing? And I guess to try to get them to begin to value that explicitly. Oh, I'm supposed to, what does that mean? I'm sorry. Oh, that's what we have left. Oh, okay. I'm sorry.
Okay. Well,
and so let me finish right there, because the rest of my comments will fit into the other one. I'm sorry.
Yeah.
Okay.
Let me just ask you a quick question on the concessionary side. Are you planning on going deeper, or are you prevented from doing that because your investors don't want you to do that because of the risk?
Please don't repeat what I'm going to say to my board. We're capped by our investment policy at 2%. I obviously would like to bump that up. And the same thing on the new and emerging managers. We're capped at 10%. I'd like to bump that up. So there it gets to the issue of what somebody had addressed, not only having participant support, but board support for the vision.
So great. Thank you so much. Really inspired by the differences in approaches, right? All the way from A1 and A2 to B1 and 2 and everything in between with Deborah. And that's not surprising, because that's what it takes. So when I reflect on where we stand in the impact economy, right, we're at the beginning of a major transformation of changing a system. And when you do that, then you have the people who want to and should work in improving the old system, and you have the people who are working on creating the new system. And all of us have to be bilingual. We have to speak the language of the old dying system, including market rate returns and what have you, because that's how you're judged by the existing system, right? And we have to also invent the new system, which is appropriate financial return for the risk that we're willing to take that goes beyond, the existing system. And so when I think about the community that I get to work with, Tonic and the 100%ers, that represents about $6 billion of committed capital to impact at this point in time. Not a whole lot, but it's very innovative capital, very demanding capital. And about 20% of that capital does not judge its financial return vis-a-vis conventional benchmarks. The point was made before that conventional benchmarks do not serve us because they don't include the impact side of the component, right? And so, but we don't have alternatives yet, and therefore many of us are working on actually creating these benchmarks of the future. So when I think about the bottom of the pyramid, first of all, you don't know what the financial return should be. Therefore, institutional capital cannot really come in at scale because they need to know. Secondarily, it's hard to measure the impact of the beneficiaries, and Acumen and others are starting to innovate on that one, so that even if you go in, that you actually can see what the impact is long-term, longitudinally again, right? I also see that the institutional capital is not by default transparent about how they do things, because it's in their interest to maximize their own income capacity based on proprietary metrics, right? And I think that the deeper impact community needs to counter that. And it's not one is better than the other. I think it's both necessary, right? But we need to figure out how to actually compare notes and by open sourcing it and we need to create data sets and technology which hasn't come up yet. I'm a technologist, right? That ultimately we allow these data sets to be mined by artificial intelligence, so that if I ask a question of how can I have deep impact in this region of the world, and with that level of impact risk, what are the opportunities for me to invest, and what's the expected financial return target for that? That is the postmodern portfolio theory for deep impact investors, right? And so that's why I think it's very, very difficult, my own point of view on that today, for institutional capital to make that bridge. I don't think it's possible. And however, I think we need to keep on working on, there's no single silver bullet, but if we continue to work on theories, on data sets, on blended capital structures, on expected returns for impact, then that will actually, over time, I think, create opportunities for the institutional capital. What is your opinion on that?
Okay. Well, I'm going to start from a very concrete starting point. When you ask a regular for-profit investor who wants to do something in Africa, the institution will require at least 15% net IRR, because they will start from the average returns in private equity in Europe, which is 8-9%, and they will say, I require a 7 or 8% risk premium for that market. So everything that you propose for investments in Africa, and which ex ante would return less than 50%, is considered at non-for-profit. Mm-hmm. Even though getting 5, 6, or 7% net IRR in your pocket is a real significant return. But no traditional private investor would go for that type of return in this type of market. So what you have to do is exactly what you mentioned, Charlie. You have to say, what do we want to do? Do we want to operate in Africa because we want to earn money? Or do we want to operate in Africa because, for instance, we want to create jobs in poor countries? Or do we want to operate in Africa because we want to elevate the level of education? So we want to invest only in education-related activities. And if we have to do that, then we can estimate what is the maximum type of return that we can have depending on the economic models, and then accept that. Now, if you come to the conclusion that, of course the numbers are not the right ones, but we don't care here, that you can invest reasonably in education for poor people in Africa and get 4 or 5% return, then it's great. It's a great improvement when compared to providing grants or government, whether they come from private or public resources. So you don't have to compare the returns of the impact activity with the returns of a private, fully for-profit activity. You have to compare them with the cost of grants to taxpayers or contributors. And then you have to do the maximum to make the activities as much profitable or financially sustainable as you can within the economic model.
Okay. Turn it around. Thank you, Deborah.
Yeah, so, I think that this challenge of bringing in institutional capital is really at its heart, it's all about what we call capital gaps. And it's a great example of these mismatches that can occur between supply and demand of capital, whether it's the innovation and novelty and the lack of a track record, the transaction size and cost, the market and political risk, the economics, particularly when we're dealing with base of the pyramid. All of these things create disconnects that make it difficult for institutional capital flow. Our experience has been, and as I mentioned before, that we can play a very catalytic role, and that we see others that can play a catalytic role in addressing those capital gaps, bridging those gaps, three basic ways. One is through this sort of managed or intermediated fund. So I mentioned Benefit Chicago. We put $50 million of our $500 million impact investing allocation, so 10%. We dedicated 10% of our impact investment resource to Benefit Chicago, and through a very sophisticated structure, created something that was very easy access, and that was part of our goal for individuals, for donor-advised funds, and for institutions to be able to join with us in a kind of small dollar, high impact investing that they wouldn't otherwise find it possible to do. And so groups like Praxis, dedicated $1 million to Benefit Chicago almost right away. So that's one solution. It's creating a structure that intermediates. The second is the sort of sequential capital model, and that's what we did a lot of in the affordable housing arena, and the example that I gave before. So Mercy Housing, for example, received nearly $5 million of loans from us. That money was their risk capital. Because they're a nonprofit, their capital gap is they cannot go out and sell equity. They can't raise equity capital. They have nothing that allows them to go out and take risk and compete effectively in a marketplace with for-profit housing players. And so our capital became de facto quasi-equity that we were allowing them to use in very risky ways so that they could secure projects, take the time to put together permanent financing, and then take our piece out. So we were never in directly the projects as a permanent financing partner. We were there trying to accelerate, and build the flywheel of their development, real estate development work. And as a result, over 5,000 apartments were preserved and improved for, again, very often very, very poor people. So that's what I would call a sequential model, where we're slotting into the right piece of the process. And then the third is the blended model. And again, I'll take another example from our housing work. Just so you know, we're launching some new work in the climate change arena, so maybe by the time of the next conference, we'll be talking about solar rooftop and some other things. But one of the things that we're very proud of in the affordable housing arena is the creation of the country, United States' first nonprofit sponsored real estate investment trust. And it is a REIT like other real estate investment trusts, but it is a layered capital structure. And MacArthur used impact investments both as preferred equity on concessionary terms, and then later we came back with a liquidity guarantee. So our total commitment to this structure is about $22.5 million. But because of the way that we structured our pieces of money, Prudential, who's here, Morgan Stanley, who's here, Citibank, and Schwab all eventually were able to come into different parts of the capital stack. And now with just 4 years of activity under their belt, over 3,000 families and individuals have homes that have been preserved and improved. And so to me, that's just the classic case. And we did about a dozen of these blended structures and found this was a very powerful way, by taking on 10 or 20% of the capital stack, that we could make it possible, not ask the institutional investor to do something outside their zone, just make it an investable proposition.
Great. Thank you, Deborah, for these great examples of crowding institutional capital in, right, by putting the right structures in place and de-risking them. Rufus, what's your comments about the ecosystem and institutional capital coming into bottom of the pyramid?
I guess I would have two major comments. The first that I certainly agree with and think there needs to be great merit is to develop additional objective forms of measurement similar to the net IRR that in some way put a mathematical figure, and I hate to say it that way, on the social impact return. I know there's several people that are working on it. There's a external rate of return piece that's being developed out of the UK by Mark Florman, but there's many others. And I think to the extent we can begin to develop metrics that quantify that particular effect or impact, it fits in to a model that institutional investors understand, and you can begin to weigh and balance things. The other thing that I'm deeply convinced of, and maybe it's fool's luck, we've actually been successful with our market rate return impact investing, competing very, very competitively and in some cases better than traditional private equity and venture. So I'm a firm believer that impact investing can return market rate of returns that ought to attract institutional investors. In my judgment, the issue is one more of unwillingness to step into the unknown. And I know I had that the first time we started to invest in Africa, unwillingness to step into the unknown. When I knew I could do something over here and I knew the people well and I knew I would get that return, to really get the confidence that I could get the same type of return in Africa doing impact investment. And I think that's the other. Sorry.
Thank you so much. Great points. So now we're going to open up for Q&A, and I want to invite 2 or 3 questions at a time. And if you want to direct it at a specific person, please say so, and then that person can respond. Otherwise, I will direct it, or we will say select. So first question here, in the middle here, yeah.
Hi, thank you very much. Joan Larea from Convergence Blended Finance. It's more of a comment than a question, but the base of the pyramid is a really large place. There are many, many poor, desperately poor people on this planet than there are very, very wealthy. And we talked today about categories of investors from A to C. What I worry about is that we leave it to the C, the grantors, or the B, the sub-commercial players, to try to satisfy the base of the pyramid. So what Deborah was speaking about, just catalyzing, is really, really important because we need that kind of money to be blended with the institutional money, the A money, in structures that appeal to all those forms of capital simultaneously or in sequence, as you said. Because if we just leave the C money or the B money to address the base of the pyramid, we don't have the money at scale that we need for the problem. So there is a role for blended finance. I'm not saying every transaction has to be shaped for the A players, but those who do have the luxury of dealing with the B kind of money or the C kind of money need to take it upon themselves as part of their mission to draw in the A money in Matt Bannock's description, to create transactions that are investable for institutional money so that we get major money into the base of the pyramid and we don't have a stratification so that the A money is off in New York somewhere and the C money is in Mauritania. Thank you.
Thank you. Let's listen to the second question here.
Hello, everyone. This is David Evans from UNICEF. I just wonder, looking at the title of this session, and perhaps, Charlie, you can feedback on this as a technologist, deploying capital for impact at the base of the pyramid. It's sort of something that's done to people at the base of the pyramid. And I just wonder, are there new possibilities? Is it a reality that we can get more of the voice, the contribution, really the voice of the people at the base of the pyramid into some of these discussions? I'm sure there's some interesting ideas on that.
Great, thank you for that question. And the third question, John?
Hello, John Kohler, Miller Center for Social Entrepreneurship at Santa Clara University. So I wanted to tie something that Maya said in the first session where she described at TPG Rise they had a discipline to not only have a good screen on the financial return but also on the impact return, and they had put together a rubric which informed them on a threshold for impact. And if the question in your panel, Charlie, is how do you bring institutional capital more involved, get them more involved in base of pyramid kinds of investing, then my question back would be, why not simply have that same threshold applied to all investments that an institutional investor is making, not just the piece that they carve out for impact investing?
Okay, great. So let's talk to the panelists here. And on point number one, I assume that nobody would disagree with the assertion of the question that blended capital can be used, as Deborah so eloquently formulated it, to crowd in other institutional capital. Or is there any other comment on that?
Yeah, I just think we have to be also realistic about what the challenges and complexity are. So we've been involved. We've done, again, over 200 investments. A very large number of those have involved blended structures. We have the luxury of being able to take the time and bear the cost that can often be a very drawn-out process, depending on how many folks you're trying to bring to the table. We're seeing now, great organizations that are out there to create structures, organizations like Convergence that are resources. So, I'm hopeful that it can be improved upon and that we can get more efficient in how we do it. But I think there's always going to be a tension, because there'll be transactions that are just too small for a blended structure to make sense. And I think we have to be careful not to overcomplicate. So I think there are times when it makes sense just for a group of B investors. We're all learning to use the framework. Here we go. But there'll be times when a truly an ABC structure makes sense, and there'll be times when it's just not cost effective. So I just think that issue of effectiveness and efficiency in the blended arena, it's something that we'll all need to keep working on.
Great. Who would like to respond to UNICEF's gentleman's question about done to people versus involving people in figuring out how to do a partnership of impact? Yeah. Do you want to start out? Yeah. Jean-Michel? Okay. Okay, then, yeah.
No, go on.
Sorry, yes. Well, maybe trying to link, to two or three questions, comments at the same time. It is really possible to address the bottom of the pyramid challenge on a fully commercial basis if you are investing in activities that have low margins and high volumes. Okay, when you can cut costs and then apply and sell the products and the services to vast groups of people. So this type of activity as well, in fact, there are not that many areas in which you can do that. Okay, so if you look at, for instance, my example in Mauritania is a very small country. There are a few million people, and it's very hard to get costs low when you're operating in the valley of the river Senegal. So there's no chance ever that you will reach out to the poor. No chance ever on a fully commercial basis. And in our case, for instance, we helped, and we are helping with these investments, growing out of poverty tens of thousands of people on a commercial basis, because this specific business is getting actually a 10, 12 real return in euros to its investors. But cost of doing that gets back to the fact that for the ultimate investor, the net return will be more on the 2 and 3. And there's no way you can do it differently right now. Now, if you do exactly the same thing in India, okay, with 1 billion consumers down the road in front of you, maybe you will get your 10 or 15% net returns. So this question of cost and volume is absolutely critical to any economic model assessment when you go to the bottom of the pyramid. Having said that, and I will end that with that, technology is changing it in several ways, because it helps addressing vast groups of people across the world, because you're less linked to a specific geographical area and you can cut costs. So that's why, for instance, in activities like education, or health, etc., or energy, you can imagine changing the economic models and getting into these type of areas with much less blended money, much less grant money, and in some cases maybe no concessional money at all, and eventually being able to address those markets for the poor. So this is really an evolving situation, and we have everything and every time we meet a situation in which we can have this bottom of the pyramid goal reached through market activities, we have to take this opportunity and do it. But it will be only in a certain number of cases that we'll be able to do that.
I would like to, Rufus, if you don't mind, go to the next three. We only have 5 minutes, and then give you an opportunity to respond to the next batch of questions. We didn't answer John's question yet. I think they have to be regulated in. There's no, it's not going to be sort of a voluntary, compliance there, in my opinion. But let's have this stay in for discussion over lunch and get 2 or 3 more questions. Another question here? People are getting hungry, I guess. One more here? Yes, please.
Laurie Spengler, Include Capital. I certainly appreciate the challenges of attracting institutional capital into BOP business solutions and models. But we've heard from the panelists, and we've heard today, there's a widening of interest. There are a greater number of solutions. And I'm just wondering, while we're still morphing to the new paradigm, the new world, Charlie, how much of this at the end of the day comes down to leadership? I mean, Rufus, you really touched upon that. Institutional leadership, particularly where people are managing money on behalf of asset owners who are expressing a desire, a caring interest, underpinned often by their values, faith-based or otherwise generated. So how much of this is really about leadership, even while we're building the new world?
Thank you, Laurie. Maybe one more? In the back there, please. Rufus.
I'm Michael Roundhorst with SEMA Funds. And it sort of tails on Laurie's question. There have been initiatives to protect people at the base of the pyramid, such as the SMART campaign in microfinance, to help establish standards for behavior towards more vulnerable customers. And to what extent do you, in your policies, in your internal reviews, perhaps even on your investment committee, look at those standards in order to make sure that the capital that's getting to the poorest of the poor is benefiting them?
Mm-hmm. Great question again, keying off a couple of others. So unless there's one more, then we'll answer these. And maybe Rufus, you can start talking about leadership, the leadership question.
I honestly believe that that's the fundamental question. Leadership, not only by the investment officers, but also leadership by the boards to whom they report to. And I think it gets back to developing those alternative measures and all those other things. So I'm actually more positive that we may be further down the road where investment committees begin to do what RISE does, say we want both returns to be there. And being willing to reject a perfectly financially viable project because the other effects not there. So I think the measurement needs to be there. But it's not only the investment officers, it's the boards that are extremely crucial in my judgment. And I think part of in that measurement has got to be what UNICEF raised. It's got to be in collaboration with the people at the base. And we've worked with some interesting agricultural projects that really involve the neighboring farmers to develop better products and all that. So I think it can be done, but I think that's got to be one of the criteria. It can't be something imposed from the top. Mm-hmm.
Are there any other comments with respect to the imposition versus participation of bottom of the pyramid?
Well, I just have a follow-on on the leadership point, which is that I think that that's absolutely right. But at the same time, we also need to look at partnership as another piece of the puzzle, because right now we're still this cottage industry, and we're each all out inventing our own sort of different bespoke wheels and figuring out whether that's how to do the impact measurement and how to do blended finance and all of that. And what we're just slowly beginning to do is create collaborative structures that allow that kind of sharing and collaboration to happen. And I believe that part of what we need to do is very consciously create opportunities for partnership, so that those of us that do have a thriving practice of catalytic investing, that we can find a way to connect with others that are doing that, and we can be less of a fragmented industry.
quickly.
Yes, I wanted to make a comment on regarding what Reverend Rufus said earlier regarding the external rate of return. It's absolutely crucial that from the very moment we start that saying that the IRR is not the only measurement, the performance measurement instrument, that we establish very clear performance standards for the vehicle, extra financial standards for the vehicle we operate. In our case, this has been a long search, and we have come now not only to a very strict extra financial performance measurement compact for each and every of our vehicles, which is defined ex ante, but we also link the revenues of the management corporation to the external performance, the social performance of the vehicle, more than the financial performance. And it's only when you get to this very financial and egoistic point of how much you are going to earn and why and base of what, that you start really discussing very precisely and a very active way with your own investors what the ultimate objective of the fund, of the financial vehicle is. So I would really urge each and every of you to demand to their fund managers that there should be a performance contract measured on the basis of the social performance and not only the financial performance. This will change everything in your relationship with them.
Putting at least half of the carry into impact metrics will change things, and we're working on that. So I have the privilege of closing this panel. Thank you so much for your attention. And I want to close with one component that hasn't been mentioned yet, and that's really the level of awareness and consciousness that needs to change in order for the investment committees to not judge their decisions on maximizing their financial return at the expense of humanity and the planet. And I think we need to hold us and everybody else accountable on that. Thank you very much, panelists. Great discussion. Thank you all for staying here. Have a great lunch.